Before we get started, I want to do a quick disclaimer that nothing we say here is investment advice. As well, nothing we say is marketing or advertising for Marlowe Partners or any of their funds. Everything is meant to be informative about the industry. Welcome to Other People's Money. I am joined today by David Steinberg, founder and CIO of Marlowe Partners, a concentrated long bias investment fund based in New York. David, thank you so much for joining us today. All
Glad to
right.
be here, and thanks for the lunch that we had before with Jack. It was a group lunch. Thank you.
It was a lot of fun to meet you and to talk about your music. We're not going to get to talk too much about music today. We're going to be talking about the investment business. Where should we start?
Correct me if I'm wrong, Max. Your focus is a little bit more on the capital side. Is that right?
Capital is a huge part of it, but it goes into org structure, it goes into
Yeah.
process, it goes into operations, how you position yourself within the competitive landscape of investment offerings that are out there.
Yeah.
I think it's just one of the most underserved niches in the podcasting world. We have plenty of podcasts about investment philosophy. We have plenty of podcasts about macro. My partner Jack does a wonderful one. And there are plenty of podcasts where people go really deep on individual companies and stocks. And the irony is that for a group of people that love to get into the weeds on businesses and how they run and what makes them work, there's very little out there about the business of investing. And so that's really the thesis for the show.
I think this is the most important thing, like more important than the investing. I know that sounds highly controversial. People are obsessed with technique and obsessed with the numbers, but they are not obsessed with where do those numbers come from and are they sustainable? And even if you then go into investment process, that means do you have an organization that is sustainable to implement that process? And so if you wanted to ask me what is the rarest thing in the world for investments, if was an allocator, would be somebody who understands how to operate the investment business and be a business person. Because most hedge fund managers haven't even operated a lemonade stand, as they say, right? And this is the core of sustainability. And I'm lucky to have been punched in the face so many times that although I started my career I did a tech startup prior to getting into investing. And lasting is the most important thing because the most important thing in investment is time. And that is only going to exist if you have an organization. Full stop.
You have a pretty interesting background. You worked for Soros before starting Marlowe. I think everybody is sort of enamored with these greats. And when you have that type of pedigree, you just get a lot of looks from people. And so you have gotten to talk to institutions that range from smaller endowments all the way up to these people who control just massive, massive pools of capital. And I think a lot of times people talk about institutional investors as a monolith. And over the last year, you've really been trying to understand them. And I think you've come to the conclusion that they actually are not a monolith. And there's a lot of variability between them. So I think that's a great place for us to start. What have you learned over this last year of really trying to understand the institutional allocator?
So I think maybe the best way to talk about this is a story of maybe me about 9 months ago or so. I was making the decision about whether or not it made sense to scale up our capital base. And we had been managing a few $100 million. And remarkably, you could actually generate quite a lot of wealth with not as much money as these big firms if you do well. I wasn't really sure if, number one, we were appropriate for these larger institutions. Think of maybe it's a pension fund or a sovereign or a very, very large foundation. And You know, I think there's a very strong incentive in the industry to raise money, which makes a lot of sense. Our strategy is much more about being able to exist for a very long period of time. And so I had to kind of learn the customer wanted, which is just interesting that it's very transactional, right, in the financial industry. And I thought to myself, well, what am I all about as an investor? I have to understand that. And it's good to write that down. So I wrote this actually, it's a book. We need another investing book in the world, I'm sure. It's called The Ocean Doesn't Care About Your Swimming Lessons. And the first line is, the ocean doesn't care about your swimming lessons, and the stock market doesn't care about this book. We'll have 50 books printed probably or something like this. But the reason you go out and meet with the allocators is to understand them because you want to be helpful. We study businesses as an analysts, but what about us? The customer needs to get value, and that value could depend on the product. So if I'm, as I was telling somebody in Singapore recently, I'm a vacuum cleaner salesman, let's say, and I'm really good at carpets. But if you're hardwood floors and stone, I can't help you. I want to, but I would say no, because eventually you're going to learn that we're really not very good at hardwood floors, but oh, show me a carpet and it'll be great. So there's IR functions and these sorts of things, but there's nothing like speaking to the principals and CIOs of these capital bases and asking them, what are your challenges? What do you need? And how is it designed? And is this useful for you or not? And take the point of skepticism that we're not useful. And you can only do that if you don't need to raise that capital in an odd way. So, yeah, your question was, is it a monolith? It's not in the sense that people say family offices. Well, I could tell you about a range of different kinds of challenges families have that I've just learned. And I'll tell you, Max, it's really fascinating. It's not all the same. There's some institutions that might have a 5-person team, and then you might have an endowment that has like a 20-person team and a consultant. And so what you do is you just learn first the mechanics of how it works, but most importantly is, can we add value and are we helpful? And if that's true, we're not pitching ourselves, selling ourselves. We're explaining who we are and how we have a hypothesis that we fit that piece in terms of your goals. And maybe we're right, maybe we're wrong, but you let us know. And that also requires sometimes saying no to folks who it's so obviously not a fit. Saying no to one sovereign wealth fund, that was kind of awkward. And it's not because of a negative thing, it's just because it's so obviously not a fit, including recently a large endowment.
What are
You
the
know,
problems that you think arise from taking on an investor who's not a fit?
the way I look at investing is that the most wealth created is the parabola of compounding. That requires time. So if you have an investor that wants that, but they don't have time, and it's structurally just true. You could see they don't have time. An example could be there's going to be a succession in the family business, and they're going to need capital. I might ask the question politely, like, if you need significant capital in several years, you won't get the benefit of the way we do it. So I guess that's kind of the thing. The best we could identify is a structural problem. And then beyond that, we just say, well, it's up to you. And then also the other thing is like with locks and these things, we operate now. So we're sort of at this, smaller scale. And then we're on pace for the $1 billion capital raise. But like you look at it, we have a 1/8 per quarter liquidity, which means it takes 2 years to take all your money out. But I've learned something too, is that you never want to force somebody to be a long-term investor. And if you have a customer who is locked into your product, let's say, and they don't want to be there, but they're stuck for 3 years, is that positive? I personally don't like that idea. So I think that there's a lot of fixation on the right partners in terms of structure, like locks and these things. And I think there's something to be said for that. We will have a lower fee structure for those kinds of investors. It does make sense. But at the same time, you just have to kind of accept that not only is it not a monolith, can't predict the future. And so the one thing I know for certain is that our cost structure is something I can control. And the other side, to some extent, will be cyclical, maybe. And so you create a pre-solution to the various kinds of variations out there. So we're sort of talking in really broad terms, but I had to see for myself if we're a worthy product to sell. And I was kind of surprised because in investing, it's a very much the opposite of explaining yourself. I would say that normally, and I hope I don't become charismatic suddenly, is that a lot of the charisma and the stuff, it's very contrary to the kind of investing we do, where Our basis is very rational and it's very process driven. So I think, unfortunately, some of the really great investors might really struggle to find the really great capital allocators. And that's an unsolved problem that some people are trying to work through, but that's a very interesting one.
Concentrated investing has struggled recently to raise assets, with the exception of the sort of greats of the concentrated world who have these long track records, long histories of success. So I think anybody would be surprised to find that there are these large institutions out there that are interested in going for a concentrated investor. So, with those people that you have found fit with, what are
Mm.
they looking for that says, "Hey, a concentrated long-term investor with a lockup actually does make sense for us?"
Let's just kind of like get kind of in the same information space in a way, Max. One thinks to oneself, okay, we are a drop in the bucket in an ocean. Like, is it hard for people to raise capital? I don't know. Where does the data come from and what are they doing? And I don't think there really is any manager that's exactly the same. If you want to build $100 billion from scratch, I don't know. We have to appeal to at least a little chunk of a lake or something like this. But you can often have just a few investors, and that's perfectly fine, and the capital compounds. So um, I don't know if there's ever a good or bad time to do anything. I would probably say that relationships really rule the world is what I've learned. And when I say relationships, I mean trust. I'll give you an example. There's one very large investor that ended up investing in a company, and we had an overlapping thing. They had a direct investing team, and I didn't even know they were allocators as well. And we interacted with them over the years on this investment. When I was invited to visit them related to this capital raise, I brought a framed picture of the stock chart that we were because they were the largest investor. And on the bottom, I wrote, Marlowe sells at the low. And they were like, we get the joke. And the joke being that I showed them what we took that money and what we did with it because it was going to take too long, we thought, from an opportunity cost. And we were right. But that was like 8 years of talking to them without even really realizing it. If you're going to have a long term business relationship, how do you build trust? That takes time. That means that, for example, we have a timeline for the capital raise just to stay organized internally and also to help others. However, I always say we're here, and it's okay if maybe down the road somebody wants to do something. So I think it's just more about the strategy and the goal and the mission has to be clear. And that will inform what you're trying to do on terms of raising capital, if you should raise capital at all. Because this is an industry that's very capital obsessive. But one thing that's very special about you, Max, is that I think that you have an interesting conception of the future of capital. And that's changing in terms of just demographics. And so this is a bit broad, but just to get some specificity, you have the old way, which is still the current way. And those individuals who are CIOs, they're starting to become people who they're in their 40s and then 30s. People get older. I remember when I started Marlowe, people said, you're so young. And I just said, well, that solves itself. So I guess what I'm saying is that I had to first verify that the institutions were interested, but I was going to do it anyway.
It sounds like your strategy is to stay around. So many people launch their funds and it's like, if we don't hit X by year 2 or year 3, we're gonna be out of business. And it sounds like your strategy has been, I know that we can survive no matter what happens in this raise or the next raise because of how you've structured your costs. And so that allows you to develop these relationships over a long period of time. That's your bet, is to outlast.
It doesn't even have to be a bet per se, right? Because the money compounds. So maybe this comes back to the thing is how much money do you have as an individual? That's a tough thing. And look at venture capital. We have literally an entire industry, which is probably maybe a little overdeveloped perhaps now in terms of capital, where people have product ideas, they're innovative, and they sell equity in a business that doesn't have profits, let's say. Now you look at the investment industry. Somebody launches a fund. The expectation is not only that within the launch they're profitable, but they're going to get bigger and bigger and become like rich quick or something like this. And I think that a lot of managers that I've met that are older than me and been doing it longer than me, they've never run a business. And running a business is being a problem solver. And if you're going to make a claim that we're going to do this for decades, you have to demonstrate that not just on quantitative stuff, but in the qualitative. It's like, what motivates you? What would a venture capitalist ask a new company, right? Like, a lot of it is going to be about the operations, about the people, about the opportunity, these sorts of things. And then what do? They sell equity. So, like, I had this actually audit, Max, maybe I'll tell you a quick story about equity just to show you how absurd it is. There's a former employee of ours, and they had what's called phantom equity because it's all partnerships, the master feeder structure, and it's all partnership structure. I wanted this person to retain equity because they were involved in the long term. And it's not like at Google when, what's his name? I can't pronounce the last name, starts with a B, but when he
Bryn.
wrote his, no, I know that one. No, at Stanford, he wrote the $100,000 check and he spelled Google Google instead of Googol.
Mhm.
Anyway, so they created a bank account with Google with the LE. It's sort of like this, maybe apocryphal, but that's the story. Um, and the concept was I'm backing them. And that person made a lot of money by owning Google, but it's not like later on they said, "Oh, well, you don't work here. You're not on our advisory board, you're not whatever, so your equity's gone and you have another job." So that alone is sort of an odd thing to me, that if you want to create a sustainable business, it's just strange that the structure, even just beginning with the legal infrastructure, is to focus on what's happening immediately because you don't get any terminal value from a business. It's assumed to have nothing of terminal value. So we tried to do this and we really struggled. We couldn't, like, this person happens to be retiring, but it's like, how do you do it? And the idea that you couldn't have somebody retain equity in a business, even though they're not working there, like that happens all the time.
I'm sure
So,
something could be done that's pseudo equity, right?
well, here's the thing is that because the industry is so well developed, once you do something that is outside of the standard, it's considered a risk or it's considered work. I don't know what. Different things for different people. But if it's new and different for institutions, it's more work for them. And I used to sort of be more like cynical, thinking, oh, that's good for them and they wouldn't want to do it. But when you go on the other side and try to learn about them, you see how incredibly difficult it would be to have first a new relationship. They're proposing a completely unusual structure. It's like all these things they have to do. It's sort of like saying to your customer, "Hey, I've got my vacuum cleaner here, and tell you what, we're gonna give you the vacuum for free for a year, and then assuming you collect this much dust, we're gonna verify the dust." And they're thinking, "Listen, I just want to buy a vacuum cleaner. If it's a good vacuum cleaner, that's fine." And I understand that, but it creates a bit of a calcification of what you're able to do. And Max, what I think what you're doing and why it's a pleasure to talk to you, I hope it's helpful, is like looking at what's going to be coming in the next few decades. And I think we're now at the point where people are interested in things like X. I started going X for the first time under my hobby name of Peter Lake Sounds, but people are interested. And in a few years, the CIOs of these institutions will have grown up with this. And I think that the structures are going to change. The investors are going to sort of have a different mindset instead of replicating kind of a Swenson concept. So you have legal, you have compliance, you have all these things that are essentially an ecosystem designed to continue the current structure, which is why we will be the regular. But I'm quite excited about one thing we're doing, which is different, which you gave me the idea for.
Yeah, I wanna hear about this.
I have an advisory board, and I mentioned this to them, and there's a maximum. And they said, "It's stupid." And I said, "What's stupid?" They're like, "You have a share class where there's a minimum of 250,000. Is that legal?" And I said, "Yes, it's the new." I explained it. He said, "But you have a maximum of 3 million. Why?" Because it's a much lower fee structure. And I said, "Well, because that is allowing more people to enter Marlowe and participate. And if they want to participate in more scale, they can continue to evolve to the other share classes, but at least they can get started." And then I had a large capital source say to me, "We don't like this. It's not fair." And I said, "Well, why isn't it fair? You could, they're looking, let's say, doing $100 million. I said, put the first 3 million in that, the next 97 in another one, which is also fairly fair and favorable." But I guess the point is that, you know, somebody who can be direct and invest, I think, is a new phenomenon. And I think that the methods of awareness, like X, is very important. And I think that this is not happening just in investment management. It's happening in research. I mean, look at like YouTube, right? Versus, linear TV. I mean, these analogs are everywhere to be seen. But the main idea is this is like, why can't people just invest in the old fashioned way? And for some people, it might be interesting to see how we approach it. And if somebody, let's say, made some money in AI, probably, let's say, or crypto or whatever, these days, and they're, let's say, 40 years old and they have children and they want to put some money away for college, like this is a normal state of affairs in the US. Why not invest directly with us? They would not be able to access us because first, we don't participate in all the distributions and things. And also, like, at best, it would be through like a Cambridge Associates or something like this. And we might not even be appropriate for them for Cambridge, let's say, for various reasons. When you have a direct interaction with the principal, whether that principal is a multi-billionaire or maybe a wealthy dentist who's retired, they often can have a better comprehension, and it's almost an enjoyable experience sometimes because since we often hold these companies for many, many years, they kind of see the developments and they ask about it, and it makes them feel that they're participating in capital markets, which they are, versus, and that's a new thing that you made me aware of, whereas before it had to always be the institutions. And so when you think about markets in general, like, why is it that people are so excited about venture capital or the ARC funds and these things? It's because it's stories and it's exciting, I think, to participate in the economy. However, there are a lot of businesses that aren't like, inventing new brains or,
Oh, yeah.
growing, biocomputers or these things, right? And those people will then speak to a financial advisor, and there are all these different steps. And I think that they're getting the short end of the stick in terms of accessing a manager. So I'm excited about that share class because I don't know if anybody will participate in that necessarily. But what matters to me is that in the future, people can invest money who aren't necessarily the largest institutions in the world. And this is the first time that's ever been legal here in the United States.
It's not that it's never been legal, it's just that it's been harder to communicate with those people, and if they are not, nerds about the investment management industry, they're not gonna know you exist. And now you have a way to communicate. I mean, they still have to be accredited if you are a 3C1. They still have to be a qualified purchaser if you're a 3C7. It's just that if you elect this 506C designation, you can tell the world what you do. You still have to follow the marketing rule. You can't cherry pick returns. There's
Of
all the
course.
rules that you were held to previously behind closed doors where you had to verify that accreditation first. It's just that now you can go out there and tell people what you do. And yeah, there are people who their job is to shop at the marketplace of investment products. That's what an allocator's job is. And so, of course, they know when a new product is launched. If you're a buyer at Kroger, you probably have a good idea of what all the new products coming out of Procter and Gamble and Kellogg's. But if you're just a shopper, just a consumer of food, you have to be walking down the right aisle to notice that. And, for a period of time, those people were not even allowed in the store.
Yeah. And they couldn't. I mean, our minimum was always $10 million. Why? I don't know. We just picked that number.
I think it's a really interesting concept because you see so many people trying so hard to come up with a model that they think better suits allocators because when you look at the marketplace, you said no fund is the same, and that's true. But there are a lot of funds that have similar results and similar strategies. And so the founder says, well, if I can just structure it so that it's more beneficial for allocators, they'll pick me over these other people.
The reality is that once an allocator trusts you, sees the process working, sees what's behind the numbers, and it fits what they're trying to do, the fee structure should become fairly irrelevant quickly. And so nobody wants to buy something because it's cheap if they don't have trust and they aren't persuaded that the particular thing being offered is absolutely the world class and the best at what they do. So I think that if you're starting off, I'm a bit of a hybrid, and I guess in a way, now that I think about it, because I have this experience of being independent. Um, and so I say launch because that's what the allocators refer to me as. So the allocators. They're different, all sorts of different potential partners, and but the reality is that you don't tell them what to do. You know, you have to understand: are you solving a problem, and are you going to be helpful? And like in some ways, the fee structure should become the secondary concern, the primary being almost like, is this my business partner? And is this process sustainable and can that be demonstrated? So it's very qualitative. And then if that's established, everything else can be icing on the cake. And for my kind of investing, I like the idea of at least allowing high net worth individuals to participate over time, even if I don't expect that today to be a big source of capital.
Well, so you keep talking about process. I think that's really important, specifically for fundamental investors. I have found that many of them fall into the trap of marketing their companies, marketing their positions. They do all of this work. They find these great companies that they're so passionate about that they develop relationships with the management team over time. And so when they go out and they meet investors, and they say, "Tell me about, your portfolio. Tell me about what you do." They start talking about these great companies that they found, and they don't talk about the process that helped them uncover those companies and why they like to be long term and how they think it helps them make better decisions over time. And so you keep talking about process, and I know it's very important to you. You've worked a lot on actually implementing AI in your process. So how do you, as a concentrated investor, communicate your process to people?
Well, I think you can get enamored with process too. Even like if I may just Max, before process, you have the business, right? What is it about the business structure that you've done to make sure that it supports the process, which in turn supports the portfolio, which in turn supports the returns, right? I'm very happy to talk about our process. I think it's important. Um, but even before process, it's like, okay, how many people should be involved in your investment process? How are decisions made? And forget the companies. How are you sizing positions? Have you thought about taxes? Have you thought about the office layout? Have you thought about the lifestyle of the people, the manager? You see, the process only matters if you're going to do it and it fits your personality and the personality of the people who you're working with. And they work for me. They don't work with me. There's always thinking of the boss is like, oh, we work together. I'm absolutely the boss. All the good, all the bad, it's all me. So when we go through a process, that's a way of creating a social contract where it's outside of me. But the first things we start off with are qualitative because it's becoming a commodity to create a financial model. It already was, frankly, years ago, you before some of the new developments. So here's a question that an AI might struggle with. What is the evidence that suggests that the business is going to be there in 10 years? That is one of our earlier questions. And there are different answers. But if you can't actually definitively say that you can prove it's going to still be there, what are we doing here? And so we'll just pass, even if it takes a little too long. So often, what's happening now is that the qualitative, with mixed with I think the discipline of valuation and also really the discipline of the AI. Of for us, it's we call it Mycroft when we develop, but combining that qualitative with the AI, with the discipline of that, is very important. So I would just say in terms of process, what's becoming more rare is that as the barrier to entry to the financial data is just getting lower and lower, we have Bloomberg terminals and these sorts of things, but it's very low valuation metrics, book value, what you'll see in the annual report. Now, that's often where the so-called fundamental investor will end. But you see those outputs, those that middle layer, that's the result of all these things that the company was doing. So my question is, how did they do that? How did they do that middle layer? How do they generate those sales? How do they do that? And that inner part is what really matters. So just to connect this, that just as I think allocators over the next 20 years, we're going to see a generational shift. We're also going to see, I think, a shift in terms of the kind of research and stuff that people use, where people should learn how they do that. And if you learn how they do that, it gets pretty simple.
So does that resonate? I feel like people have been burned by these sort of middle layer people that you're talking about. Obviously, there was a great run for that type of investing in the pre-GFC era where just buying companies that were trading at reasonable prices and betting on that mean reversion worked very, very well. It hasn't worked as well for the last decade plus, I would say.
We're a very good strategy to investigate in terms of understanding whether we're good at it or not good at it, and whether it fits for their goals or not fit. And the reason is very simple. I'll give you a for instance. Somebody will say, well, how will you perform as a manager and a portfolio manager in a major crisis? Well, we have a COVID case study because I was managing the money during COVID and I could, and, showing you play by play exactly what was done, you know? Um, so when you actually have the evidence to show what's done and you see the consistency, it's a fairly easy thing to investigate. Now, whether or not somebody says, ooh, this is good, this is not good, that is based on their internal goals, their process, their constraints, their opinions about what they're trying to achieve. Just take family offices. One of the most interesting things is when the principal is the one who made a lot of the money is present and involved, because often a little bit to the chagrin of the professionalized CIO, if God forbid the principal is in the office and I'm explaining like what we're doing, I've had multiple occasions where they sit in and like, and how much? What percentage of your fund is in this? And I'll be like 12%. It's like, what? It should be 100, you like because they are very into
Yeah.
business. And you know, the CIO was in all these cases, they're often very astute, but they have a complicated job depending on managing maybe a principal and like, what is their goal? Wealth preservation? You hear that. So it, it varies. Generally, what I've learned is when they say it's wealth preservation, and I say, well, we're not for you. I'm now starting to realize that one great way to preserve wealth is to make a lot of money because wealth preservation of being super diversified, what happens is that you don't know what you own, and then you have a turnover and all these things. So it just varies. It's back to your point about a monolith
Well,
thing
why
would
don't
be
we talk
like.
about AI in the investment research process? You have really gone all in on putting this into your process, something that I think is becoming clearer and clearer every day. I was reading something about like Norges Bank. I think they have 700 people on their staff, and the CIO recently made comments about how it's mandatory to use AI, and they're trying to make everybody do it, saving hundreds of millions of dollars a year. You probably don't have $100 million worth of costs to cut, but you've cut a lot of costs, improved a lot of processes by putting this AI in. Talk to me about how you've done that and where you think it's going overall for the industry.
It comes back to what is your system that you're trying to optimize for. So there's one individual, and I'm going to relate this to AI, is this guy, William Deming. I like to talk about him because I feel like he's kind of an unsung hero of efficiency, and he would love AI. So Deming has all these ideas about systems and efficiency. And as I understand it, after World War II, nobody wanted to use any of his systems, any of his efficiencies. This is like in the 50s. And so during the reindustrialization of Japan after World War II, they said, okay, let's take this professor who's obsessed, and let's send him to Japan. So that all these systems in Japan, and we're talking about things like when you have a conveyor belt, it's like stuff goes down the conveyor belt. Well, maybe it's a good idea to have the truck at the end of the conveyor belt because then when the stuff is there, it's right where the truck is and it saves you time. And it was embraced by companies like Toyota and stuff like that. And then to me, kind of the greatest irony is a lot of it was re-exported to like Harvard Business School as like the Toyota way, all these things. But it actually originates a lot of it with an American named William Deming. And so he's a systems analyst. And some things that he says that we really focus on is he says, we know how to optimize pieces, but to optimize for a larger system is hard. It's like the most basic stuff. I love this one. Management by numerical goal is an attempt to manage without knowledge of what to do. The basic fault of the annual appraisal is that it penalizes people for normal variations. Like this is called common sense. So what we learned pretty early was that regardless of the model type, I mean, I couldn't have guessed that language would have been the basis for it. A lot, and maybe we'll evolve beyond that, but the large language models, that language is the basis. And when you're training them, we were very early to, it's hard to say this because it feels so simple and basic, but it turns out it's not that common, but I think it will be. Is that when you train something in a vertical, it's very quick to get very, very smart, which kind of makes sense, right? So Mycroft is our AI system, and people use AI. Of course, use AI. It's sort of like kind of nowadays using AI. Using AI is a little bit like saying, "Oh, I use Google. I use the internet, answering questions and stuff." So the question starts to become like, well, how do you use the internet? How do you use Google? And certainly, there are a lot of jobs that you can just do more efficiently. For us, what's been interesting is that because we have a process that is literally questions, it's a question-based process. What is the evidence of this? What is the evidence of that? We decided to start splitting it up and saying, okay, let's just take this vertical of saying like, let me start with management incentives because it's a very basic one that's quite applicable to a lot of things. We have a long list of things we look for management. Nothing is going to be earth shattering that I'll say, but it's quite a comprehensive list. You can train an AI just in that one very, very important and specific thing. And that's stuff like succession planning. It's stuff like capital allocation. There's a lot of things to say, the compensation structure. Okay. So once you have your list of questions and answers, you could take a large language model and train it in that one area, right? And it becomes incredibly smart at that one area. It would be like the worst GPT for anything else. But the point is this, if you then have a process, you divide it up into pieces and you specialize the brain for one of those very specialized pieces, the speed with which you can train it and it gets very smart, it's quick. So what happens is that as you go through our process, you have outputs of very specific areas. And those outputs together then have the bigger micro brain consolidated into the company analysis. This is something that anybody can do. However, you have to know what the questions are. and what you're specializing it in. And what I have learned to my surprise, I guess it's not surprising, it's just common sense that AI companies don't know much about investing and about fundamental investing. And actually, it's even a more rare thing these days as a general matter because most of the market, about two-thirds of the market is passive, multi-strategy, things of that nature. So who's around that has a systematic process that they've been using for a decade now with specific questions? Well, that's us. We didn't think it was a big deal per se, but we then started training it in all of these things. And the outputs basically allow us to run a process on a new company that could otherwise take perhaps a few months very, very quickly. That's one element of it. But the key thing is like we sort of joke, like, what if somebody really, really hardworking or 24 hours a day is open to being very trained and specialized, shows up at your office? What do you do with them? It's actually not an obvious answer because it's going to come down to what are you doing as an investor? And if what you're doing as an investor is variable, if it doesn't have duration, so you're not going to want to invest the time to have it learn a particular thing because you might change what you're doing next year or in a few years. All these criteria make it very hard to use the power of the AI to discipline your process. And so the savings on the AI, it's remarkable. It is absolutely remarkable. And that's just one aspect of the process for a pipeline. But then you have, like, for example, our positions. Everything we learn over years gets integrated into a specialized AI for that position and for that sector. And so everything is a bot, that we'll ask questions about it. So when we're triaging something, it's incredibly current. It actually reminds me back in the day when I used to be an analyst, I would have to sometimes have very quick recall, like, David, what about that thing? And what I used to do, Max, I'll tell you, is I took all my notes, like hundreds of pages of stuff, and I put it in a massive PDF. In some ways, for the bots, it's a little bit like that, but it has also all of our own things. Everybody's looking to make money quickly. Everybody wants to get rich quick. It's natural. If that wasn't the case, we couldn't have markets because we have no liquidity. We need that. We need that speculative element. But we're sitting pretty here because we get the benefit of having this AI do what it's just so good at, which is specializing in a very specific thing. It's not that we have some sort of special data, it's that we have a process. But just to Mac, give you an example, our documents, even where the heading is, title, is like the same number of spaces. But these actually details made a difference early on when we're starting to translate a lot of these things using Python to translate into a JSON file to get essentially new brain created. But that allowed us to be very rapid. And it's kind of interesting now in the sense that we need to develop trust and alignment with our partners. And that can only come from us demonstrating what we've done historically, showing what we're doing, and seeing if it's helpful for them. Now, trust is very important. If an AI tells you, Max, you should go to the hospital and they're going to make a small incision on your lower back and you're going to go under a general anesthetic, they're going to stitch it up and it'll change your life. Why? We don't know because the neural net that gave this recommendation is so advanced, we can't audit it. Now, here's the thing, Max. It's probably right, is the thing. We don't know why, maybe, but it's probably right. But do you want to go under a general anesthetic? It's one of these things. And if you're in a concentrated fund and you're going to have things go up and down all the time, it happens all the time. I mean, one thing we hold that's now up of 800, 900% since inception has had countless 30% declines and at least two 50% declines. And so we could triage this. We're not just like, oh, we're long-term investors, compounding, la, la, la. No, we're like, we're probably wrong. What's going on here? And we really vet it and we triage it and we are all over it, understanding that intersects inner to this, to this, to this. And in each case, it's actually been fine. But if an LLM is telling you to do this next, and it's down this much, and it says buy more. I mean, it's hard. And if you actually pull up old videos of the late Jim Simons, may he rest in peace, is the only time they ever had an issue with the medallion fund was when they didn't listen to the model. That's the only time they had issues with it. So we are by no means the medallion fund. But what I'm just trying to get at is if you're looking at investing for multiple years, you're going to need to have a trust in the system and trust in the people and an understanding about how it works and being able to see why things go up and down and understand that. And we're very well designed for that. To just the transparency is so easy. Often it's almost a little bit boring because the companies don't change. So on the one hand, AI has allowed us to operate at a level that I just don't think was possible with humans, to be honest, frankly. Because the thing is that you can only have one portfolio manager, and I need conviction. And you could have the greatest analyst in the world, but how do you get the conviction to be able to make it this big? So, because when something goes down, we're not opening a spreadsheet, right? We're not, oh, it's the mean reversion taking place. There's a point where panic takes over. And there's nothing more powerful than fear and panic, nothing more powerful. So, what I'm getting to is that AI basically makes our process better, more disciplined, and our cost structure insanely cheaper. And we're not getting disrupted by it. Because if you're trying to make a call in the corridor and things like that, the standard um, approach of hedge funds is going to be very much at risk in the years ahead. So we are very, let's say, lucky to be, I think, at the right place at the right time, from lowering our cost structure and being better in some ways, and also benefiting from one of the few strategies that AI is not going to be replacing.
You talk about the commodification of a lot of the data that's out there. It also sounds like somewhat what you're doing is you're taking very unstructured data, qualitative data, and systematizing it in a way that becomes proprietary rather than commoditized.
So, I'll give you an example. If you have, let's say, a company that is a fixed cost structure, and that fixed cost structure can support double the sales, and you learn what that fixed cost structure is, and truly it doesn't require a lot of reinvestment, and even with inflation, it's actually like quite fixed. There are a lot of ways that you might want to investigate and prove out that it's really fixed. And the number of things that we would want to find in the real world to kind of just understand why is it really fixed? How does it work? That kind of task can be allocated also to some of Mycroft's minions, should we call them? As an aside, Mycroft is Sherlock Holmes' older brother, and Sherlock Holmes is the detective. And in the original Conan Doyle books, which I've been reading to my kids, they talk about Mycroft shows up and Sherlock says, "Oh, Mycroft's here. Something's really bad." Watson's like, "Why?" And he says, "Because he runs the whole government in his mind." So everything has its right place. I suffer from having a much smarter older brother as well, so I relate to Sherlock. But Mycroft, though, we can then use this as a resource to investigate maybe 4 or 5 additional things that might just be number crunching, that is just brute force. And that kind of brute force may have required 10 junior analysts, which frankly would forget cost structure. Just from a time perspective, it's a people management thing. You want to have a culture that is supportive of the mission. And our mission is very simple. It's 1 billion to 100 billion. And when you look at the math, it's very straightforward as a mission. But everything has to be designed for that mission. So you have the end point of 100 billion, and you're like, okay, well, what strategy does that? Then you work your way backwards. And that's Marlowe. And so we have things we can do that are additional. We've never used expert networks of any kind for all sorts of reasons. Or we can say, wow, if we were to crunch these numbers, we could do that. So then there's that additional thing. But the end answer for all of the stuff is, what is the use case? What is the use case? And are you willing to invest the time and money to then optimize these models for that use case. And that use case needs to be a multi-year, very long-term use case. That's it. Not fishing and efficient, all this stuff. And for us, AI is terrific for that. Now, if I was, let's say, at a pod, or if I was assessed on an annual basis, I'd be fighting the war like everybody else, and I don't want that. People, radically underestimate the importance of avoiding stupidity. It's a very underappreciated thing. I mean, Max, have you ever heard this comment? You should meet this guy or this girl. She's really smart. He's really smart. I would much rather operate against really stupid people, and I'm average, or win by acclamation because no one's there. And it's kind of what we're generally looking for. And this gives us the ability to do that as we always have, but with a lot more firepower. So it just amplifies us. And in my mind, I can't keep track of a lot of things. I can keep track of 7, maybe 10 companies. If you look at the Forbes list of the top 20 richest people in the world, like a lot of them are just thinking about one company. So I like to think just like an operator about one or just a few companies. So I guess what I'm getting to is that for us, AI goes deeper into what we already do versus like people ask, oh, hire more analysts, do more stuff. Even if we had the group of humans doing what the AIs can do,
You have constructed your business for longevity. You choose your investments for longevity, and you want your investors to value that and to participate in that with you. And that is really the whole idea of Marlowe, is that most people are not focused on that. And that by fully aligning your staff, yourself, your structure, your positions, and your investors to last, there is total alignment.
yeah, I think the one thing that I would just add, that's an excellent summary. I just say this. I love the idea that people want to participate in companies and learn about companies. Now, when you're starting a company, you can get debt or you can get equity, right? We want to have functioning markets where people are like, I want investors. And we want CEOs and company founders to be like, "Oh, I have great investors." They understand like that the investment, on average, let me give you an example on capital allocation. Average capital allocation could be 3 to 5 years for something to bear fruit. So, how wonderful if you have an investor base that's like, "Oh, yeah, we see that. We're so glad there's no free cash flow this year because you're gonna make so much more money." That comes from people kind of following it over time, and so so they feel good about that, and that actually is how, frankly, the investor builds trust with the company implicitly through the manager. And that is something that is kind of become very abstracted, but people want it, and you could see that through the Kathy Wood stuff because they want the stories. They want to participate in markets. It's fascinating. So I think that's the last thing I should have said. And I think we provide that without it being like, oh, this theme, right? About, biocomputers and, AI and this and this and this, where everything is being ETFized, if that makes sense. And it's why? It's because people love the story. They want to be involved. I want to be involved, right? And I think that's one thing that I would say.
Well,
So,
David, why don't we leave it right there? I think that's a great place to end it. And thank you
sure,
so much for coming on and sharing.
no problem. I hope it was helpful. Pleasure, Max. Anytime.